Use the classical model of the labour market to describe how each of the following events would affect the level of employment and real wage rate. So before I get started, I'll look into the classical model. Now what is most important here is the classical model assumes that markets clear quickly, prices are not sticky. That's the main point. So number one, a tremendous collapse in the stock market overnight. So this is a decrease in wealth, which will cause households to supply more labour because they are less wealthy. So if they are supplying more labour, then this is going to affect the supply of labour. So we're looking at the individual workers rather than the firms, and it's going to increase it. The end result is a decrease in the wage and an increase in the number employed. Number two, a large electricity surge in Auckland destroys many computers and machinery in the Auckland area. So this is a loss of capital. So we are looking at the demand for labour this time. It's destroyed a lot of capital, so the marginal product of labour is decreasing. Therefore, firms will demand less labour. Because if we were to think about it this way, if the marginal product of labour and the marginal cost of labour were on a graph, when the marginal product of labour falls, then the equilibrium where they meet is therefore going to be decreasing. Because we always hire to where marginal product of labour will equal marginal cost. So that's one way to look at it. So this will be a decrease in the demand for labour. Whoops. Just go in this line. So I show that here. And the effect of that will be a decrease in the wage rate and a decrease in quantity of labour. So a decrease in the employed. So finally, the common cold becomes obsolete, reducing the days taken off work. So who is this affecting? Well, the cure of the cold will increase the productivity of workers. So the marginal productivity of labour will rise. Therefore, firms will demand more labour. Once again, they will demand labour to where marginal productivity of labour equals the marginal cost of labour. If the marginal productivity of labour increases, well then this equilibrium will be increased. So it is a shift of the demand for labour out that way, which will increase the wages and increase the amount hired, the quantity of labour. So why does this not affect the supply curve? Well, a worker is already supplying himself. Say he gets a job for 1 month and he takes 1 day off sick. He's still supplying himself to that job for that month. However, if this occurs and the common cold becomes obsolete, then he will not take that day off, and he'll end up working 31 days instead of 30, even though he was still employed under that job the whole time. So it's just a productivity thing, rather than supplying more. So that is why it only affects the demand curve in this case. So yeah, thanks for listening, and I hope this will help you in understanding the classical model of the labour market.